Welcome to Volatility Trading Strategies. So I've more or less completed my move and I've got my office all set up so I can now start making regular videos again. I do also have a very active blog with new entries nearly every day, so if you haven't seen it already, I'll leave a link to my website and you can check out my blog articles. But honestly, I do prefer the videos. I think it's more personal, and I think a lot of you in the VTS community do as well, so stay tuned for many more. And if you haven't already, please subscribe to the channel down below. So today I want to detail a very common option spread known as a bear call spread. It's one half of the two-part pair known as credit spreads. The other one is called a bull-put spread, and I'll do a full video for that one as well. But since we opened a new bear call spread just this past Friday, I'm going to use it as a backdrop, and I'm going to explain exactly what it is, why we opened it, and how we plan to manage the trade. So let's get into some details. So first of all, bear call spreads are sometimes also referred to as verticals or just credit spreads, like I said. It all kind of means the same thing. So these can be used very effectively as either a standalone strategy where you're basically just reloading them actively on a wide variety of assets, or as part of a diversified options portfolio where you're really only taking the best setups. That's how I personally use them. This trade is part of one of our strategies here called VTS Discretionary, which does have a full explanation video of its own on my website. The purpose, beyond just great performance, is to use it as a teaching strategy. So whenever there is a new trade type, like today, I'll break it down in an article and a video and really go over it from all angles. When you see how it works and you exercise my live trades alongside me enough times, you'll start to get a very good understanding of how it works, and eventually you'll be able to take the reins yourself and start spotting your own setups. So this is our trade from Friday. All bear call spreads have this same shape. The profit range is below the break-even point here, and the loss range is anything above that point. Now the way these are constructed is very simple. It's a two-leg option spread. First, we are selling a call option. In this case, we sold the 2780 strike on the SPX. That's the cash-settled S&P 500 index. But if you just sell a naked call option by itself, that's an unlimited loss trade because if the price of the S&P keeps going up, you keep losing money. So we also buy a further out-of-the-money call option which caps the maximum loss for us. In this case, it's that 2800 strike. With both of them open together, now we know exactly how much we can gain and lose. And another benefit is this dramatically reduces the amount of margin required for the trade. So bear call spreads and its twin brother, the bull put spread, which I will do a video for, both of these are great for smaller account sizes. If you're trading with just a few $1,000s, instead of using the SPX, you could use the SPY, which is the S&P 500 ETF. It has about 1/10 of the notational value of the SPX, so one contract on the SPY requires 1/10 of the margin, only about $100, so this can be scaled to any account size. Now, one of the things that I think sometimes turns people off of option trading is the lingo. It sounds a lot more complicated than it actually is when you hear it, and people might think, well, I don't know what that means, so I'm just not going to trade them. For this trade, if I were to explain it in words, I would say that we sold a July SPX 2780-2800 bear call spread at 1145. Now, granted, that is a little bit more complicated than me saying I bought Apple stock at 150, but it's actually pretty simple. There's 5 pieces of information there. The monthly expiry. And if you hear just July, it means the monthly option cycle. If someone is actually trading the weekly expiries, they'll specifically say so. SPX, of course, is just the underlying ticker. SPX is the cash-settled S&P 500 index. 2780, 2800 are the strike prices. And since this is a credit spread, we typically say the short strike first, which is the 2780. That's the one we're selling. The 2800 is the one we're buying to cap the maximum loss. Bear call spread tells everybody what it is, because of course different option spreads have different names and build structures. Remember, vertical is exactly the same meaning. And lastly, the 1145 is the premium we bring in because it is for a credit. Now quickly about that premium, remember it does fluctuate throughout the day, which can be frustrating for newer traders. Last Friday it was trading about $10 in the morning, and by market close it went up to 1145. That sounds like a big difference, but that's only because it's one trade. Once you do several of them, you'll quickly realize that about half the time it goes in your favor, and the other half goes against you. In the long run, it'll all average out about the same for everybody. Now, I personally enter my trades near market close, but whenever is convenient for you is just fine. It'll all work out the same in the long run. Now, one thing that hopefully you've noticed about these trades is the outcomes are fairly binary. If the stock or index you've selected continues to go up, you lose money. If it goes down, you make money. So because of the binary nature of this trade, the best time to open them is when the stock or index is approaching a short-term high or resistance level. That's when it's most likely to reverse course. So why did we open this trade last Friday? Because the S&P 500 is actually coming into one of those resistance levels. This is a one-year chart of the S&P 500, and you can see that starting on January 26th, we've seen some weakness. We had the big crash and that 115% single-day VIX index spike on February 5th, which was exciting to say the least. And since then, we've been in a range. The 200-day moving average there in green has served as support, and the 2780 level has been resistance 2 previous times. Well, we're coming into that area a third time now. Remember, for binary trades like credit spreads, we are looking for those resistance lines. Now, of course, it's always possible that it reaches that resistance line and then basically flatlines and does nothing. But more often than not, it either breaks through and keeps going higher, or it fails and we go lower. Bear call spreads are perfect for this situation because nobody can predict markets with any accuracy. I don't know if we're going to break higher or fail. All we can do is just put on the best trades we can as often as we can and let statistics and the law of large numbers take its course. This is a good probability trade, that's why we took it. But even the best trades can lose money, so of course we need a stop loss. I don't like to use dollar value stop losses because they can make or lose money quite quickly. If you use dollar value stop losses, you end up with a long string of failed trades, so you need to allow a little bit of time for them to play out. So instead, there's 2 levels of risk management that I deploy. The first is trade small, very small. This trade only makes up 8% of our VTS discretionary strategy. So even if the S&P 500 is up 3 or 4% on Monday, our trade will of course lose money, but it's a small enough allocation that it won't do any major damage. And the second level of risk management is, we have to know when we're wrong. I'm taking this trade because 2780 has been a resistance area. But if we break above that and close around 2790 and approach 2800, chances are decent we'd then be looking to test the all-time high again at 2872. That's not a guarantee, of course. Stocks can always reverse course and crash down at any moment. But above 2790, I'm comfortable saying that I'm wrong. That's the stop loss. A closing price above the resistance line, in this case, around 2790. If we cross that, I'll close it out for a small loss and move on to something else. So that's the bear call spread. It's a very simple trade, but it can be really effective if you know how to build it, when to put them on, and how to manage the risk. First, how to build it. It's a short call with a further out-of-the-money long call sold together to create a limited risk option spread. When to trade them. We look to put these on when the stock or index is approaching a short-term high or resistance level. That's when it's most likely to reverse course. Lastly, how to manage risk. So first of all, we trade very small allocation sizes, so no matter what happens, no single trade can derail our forward momentum. And secondly, we set our stop loss a little bit above that resistance line. If we see a close above that, we just maintain discipline and take the loss. For this trade, if the S&P 500 is down next week, we'll make a little bit of money. If it's up, we'll just take the loss. And if that does happen, you can bet good money I'm going to have my eye on another bear call spread right around that 2872 all-time high level. So stay tuned for that. As always, if you have any questions at all, please feel free to email me. And if you do want to follow along with some of the live trades that I put out, bear call spreads, bull put spreads, and many other types coming in the future, you can sign up for my newsletter. I'll leave a link for that shortly. So thank you very much for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.